Welcome to Iron Financial. Our mission is simple, to help you forge a stronger portfolio. We do that by cutting through all the market noise, by stress testing the hype, and by figuring out the true structural integrity of a company. We don't really care about sentiment, we care about steel. And today, we are putting Blue Owl Capital, ticker OWL, to the test. This company is a perfect case study. It looks like a fortress of finance, but the market seems absolutely determined to tear it down. So the real question is, are the walls actually crumbling, or is the market just throwing rocks at a skyscraper?
Okay, let's just dive right into the heart of the problem here. On one hand, you have the company's actual operations, and that story is one of overwhelming strength. I mean, just look at this slide. $56 billion in new capital raised in a single year. That's not just strong, that is a tidal wave of investor confidence, especially in a tough environment. Operationally, you'd have to say they are firing on all cylinders. But then, you look at the other hand. You look at the market story, and it is telling you something completely different. The stock is down over 22% in just the last month. It is getting absolutely hammered. This right here, this is the central conflict we are going to dissect today. How can a company be so powerful on the inside, yet be so brutally punished by the market on the outside? That's the core question we have to answer.
Right, and that's the disconnect that has everyone so spooked. I look at this and I have to ask, what is the market seeing that these raw numbers aren't telling us? How is it possible to raise that much money, to manage that many assets, and still have your valuation just completely crumble? It smells like fear, and not just, general market nervousness, but a specific, targeted kind of fear. It suggests there's a risk, a crack somewhere in the foundation that the big headlines just aren't capturing. So before we start celebrating all the victories, we need to understand the threat. Let's get into this paradox.
And we are absolutely going to address that threat head-on. But first, we really need to understand the sheer scale of this operation. We have to start with the bull case. And the very first pillar of this entire structure is this number you see right here, over $307 billion. That is their total assets under management, or AUM. This is not some small-time operation. We're talking about a financial titan. This number is the bedrock. It represents an immense amount of trust and capital that some of the world's biggest institutions and wealthiest people have put in Blue Owl's hands. Everything else we talk about today is built right on top of this foundation.
Okay, so let's build on that bedrock. We're now moving into the bull case, and I want to show you the raw power and the solid construction that's behind Blue Owl's numbers. We're not just looking at a big company, we are looking at a company that's been engineered for a very specific kind of growth and stability. We're going to examine the steel beams that are holding this entire enterprise up. So for a minute, let's just forget the market noise and look at the blueprints.
Now, what's really fascinating about this slide is the speed and, maybe more importantly, the quality of the growth. That $307 billion number, it is not stagnant. Just look at the chart. AUM has surged a staggering 85% in only 2 years. That is just explosive. But here is the crucial point, the detail that really matters. It's not just about the total AUM. Look at the smaller pieces. Fee-paying AUM, that's the assets they're actively earning management fees on, is up 86% to almost $88 billion. And even more importantly, look at permanent capital. That's up 71% to $222.8 billion. Now, why does this matter? Well, permanent capital isn't flighty money that can get pulled out on a bad day. It's long-term, locked-up capital that can't be easily redeemed. For an asset manager, that is the holy grail because it generates predictable, recurring fees, year after year, quarter after quarter. This isn't just growth. This is the installation of a structural support system that's designed to withstand market turbulence. This right here is the core of their strength.
And where does that growth come from? It comes from right here. An absolutely massive fundraising engine. $56 billion raised in 2025 alone. And just to put that into perspective, they raised over $17 billion in the last quarter. This is not passive asset appreciation from the market going up. This is an active, overwhelming vote of confidence from some of the most sophisticated investors in the world. We're talking institutions, pension funds, sovereign wealth funds, private wealth. They are actively choosing to give Blue Owl more of their money to manage. So while the stock market is selling the stock, the people with the deepest pockets and the longest time horizons are buying the strategy. That tells you something really powerful about the perceived quality of their operations.
Okay, so they can raise a ton of money. That's crystal clear. The numbers are impressive. But raising money and making money are two very different things. Are they actually good stewards of that capital? It's one thing to have a great sales team. It's a completely different thing to have great investors. Is the performance actually there to justify this tidal wave of cash? That is an excellent question.
And this right here brilliantly illustrates the answer. That capital is not just sitting in a bank account, it's being put to work, and it's being put to work effectively. Look at these returns from their real assets platform. Gross returns of over 13% on their net lease strategy, a gross IRR, that's internal rate of return, of nearly 28% on one of their digital infrastructure funds. Across their platforms, they're generating strong, risk-adjusted returns. Their direct lending net returns were 8.7% for the year. See, this isn't just about accumulating assets, it's about performance. They are delivering for their clients, which is exactly why that fundraising engine we just saw keeps firing on all cylinders. It's a powerful feedback loop. Strong performance fuels more fundraising, which fuels more growth.
So let's connect all of this to the bottom line, what it means for shareholders. This operational strength translates directly into financial power. First off, they beat earnings estimates, reporting adjusted earnings per share of 24 cents versus the 22 cents Wall Street expected. But the number I really want you to focus on is the second one, fee-related earnings, or FRE. It came in at 96 cents per share for the year. That's a 12% increase year over year. Now, we are going to talk a lot more about FRE later, but for now, just know that this is the most stable, most predictable, highest quality form of earnings an asset manager can possibly have. And look at that FRE margin, 58.3%. That is incredibly profitable. This is not a low-margin business. And finally, all of this powers a pretty hefty annual dividend of 92 cents per share for 2026. So the bull case is simple. This is a fortress built on a foundation of massive AUM, supported by steel beams of explosive growth and high-quality permanent capital, and it's all powering a reliable, profitable cash flow engine that rewards shareholders.
All right, that's a compelling blueprint. The numbers look really solid on paper, I will grant you that. But the market isn't paper. The market is a brutal testing ground. And right now it is telling us that this fortress might just be a facade. It's pricing in some serious risk, which means it's time for us to stop admiring the architecture and start stress testing the weak points. Let's find out where the cracks are, because the market is screaming that they exist.
We can start right here. This quote from investing.com and Yahoo Finance perfectly captures the fear, redemption, and valuation concerns. In simple terms, the market is worried that investors in Blue Wall's funds are going to start pulling their money out in a big way. But the second part is just as important, mark-to-market timing. Let's be really clear about what that means. A lot of Blue Wall's assets are private loans and private properties. They don't have a stock ticker you can check every second. Mark-to-market is just the process of estimating what they're worth. And the fear is that these values are optimistic guesses that just haven't caught up to reality. The market is asking, is the value they're claiming for these assets real, or could it come crashing down when they're actually forced to sell? This totally shifts the conversation away from growth and focuses it right on risk and liquidity.
And that fear, it isn't just talk. It is being backed up with cold, hard cash. Look at this number, 94,500. That is the number of put contracts that were bought on Blue Wall stock in a single day. A put option, if you don't know, is a bet that a stock's price is going to fall. This isn't just a handful of nervous retail traders. This is a massive, coordinated wave of bearish betting, likely from sophisticated hedge funds and big institutional traders. I just want you to let that raw number sink in for a moment.
So what does that number actually mean? It means professional traders, the so-called smart money, increase their bets against the company by 240% compared to the normal daily volume. So let me ask the question again. If the foundation is so strong, if these steel beams are so solid, why are professionals making enormous leveraged bets that this entire structure is about to fall? They are putting millions and millions of dollars on the line, betting that all that good news you just laid out is completely irrelevant. They see a crack and they are trying to profit from a collapse.
And it's not just one thing. Let's break down the bear case point by point. First, you've got industry-wide headwinds in these non-traded BDCs. Let's just clarify that. BDCs are business development companies. They lend money to small and mid-sized private companies. The non-traded part is key. It means you can't just sell your shares on the stock market. You have to ask for your money back from the fund manager, and there are often limits. This is where those liquidity fears come from. And that whole sector is seeing slower fundraising and more people asking for their money back. Second, analysts are pointing out they're behind on the performance goals they laid out at their own investor day. That's a credibility problem. Third, their dividend payout ratio is high, which limits how much they can grow it in the near future. Fourth, even though they beat on earnings, they did slightly miss on revenue. And finally, the big one. The stock cratered almost 36% after they just abandoned a plan to merge two of their private credit funds. This wasn't a minor hiccup. The market saw it as a major strategic stumble that just vaporized confidence. Put it all together, and this paints a picture of a company facing some really serious external and internal pressures.
Okay, those are all valid points. The market's fear is not coming from nowhere, and we don't ignore fear at Iron Financial. We analyze it. So now it's time to weigh the steel. Are these just superficial cracks in the paint, caused by bad market sentiment and some temporary headwinds, or are these deep structural flaws in the foundation? We need to separate the real, structural risk from the amplified noise of the market. Let's put these bare points on the scale against the fundamental strengths we've already identified.
And this slide frames the debate perfectly. On the right, you have the market's fear, just crystallized in that massive jump in bearish put options. A clear, loud signal of negative sentiment from professional traders. But on the left, you have something just as powerful, maybe even more so, insider confidence. In the last 90 days, company insiders, including the CEO Mark Lipschultz and the CFO Alan Kirshenbaum, have been buying sizable chunks of their own company stock with their own money. These are the people who have the blueprints. They know every single rivet, every single weld in this structure. So who's right? The traders who are betting on a collapse, or the architects who are doubling down on their own design? This is the core conflict that investors have to resolve.
To answer that question, we have to go back to the most important metric for an asset manager like Blue Owl. We need to understand fee-related earnings, or FRE. This is the absolute key to figuring out the structural integrity. Like the slide says, FRE is the stable, recurring revenue they get from management fees on that long-term locked-up capital we talked about. It really is the steel framework. Crucially, it is completely independent of volatile, unpredictable performance fees, which are tied to the market's ups and downs. Think of it this way. FRE is like the rent they collect every single month from their tenants, no matter if the property value goes up or down. Performance fees are the bonus they get if they sell the building for a big profit. The market is worried about property values, but the bulls are focused on the consistent, growing stream of rent checks. FRE is the single best measure of the company's core, durable earning power.
So, with that definition in mind, just look at this chart. While the market is panicking about redemptions, valuation marks, and a 22% stock collapse, what is the steel framework of the company actually doing? It's growing. FRE per share grew 12% year over year. This isn't a company whose core profitability is shrinking or under threat. It is expanding at a double-digit clip. This suggests that the market's fears, while they are centered on real issues, might be overlooking the immense stability and growth of the underlying financial engine. The noise from one part of the business might be drowning out the strength of the core structure.
Okay, the FRE growth is a strong counterpoint, I'll give you that. But there's another major headwind we haven't touched on, a macro fear that's casting a shadow over this entire private credit space, and that is the massive sell-off in the software sector. Over $800 billion has been wiped from the S&P 500 software index because investors are terrified that AI is about to disrupt their business models. Now, Blue Owl has about 8% of its assets under management exposed to the tech sector through their lending. So the question is that 8% a ticking time bomb? Is the market right to be terrified that a wave of defaults is coming from their tech loan portfolio as their customers get disrupted?
And that is the billion-dollar question. So let's address it directly with what management actually said on their earnings call. They were asked about this specifically. Their response was that within their portfolio of tech companies they've lent to, they are seeing strong fundamentals. They report cumulative revenue growth of around 40% and EBITDA growth of around 50% since November of 2022. They state, and I'm quoting here, they see no material uptick in distressed metrics. So you have a very clear disconnect. The public stock market is selling off software companies in a panic over AI disruption, but Blue Owl's management is saying that their specific, private portfolio companies, the ones they've done deep due diligence on, are actually growing robustly. This could mean one of two things. Either management is being overly optimistic, or the market's broad-based fear is just an overreaction that doesn't apply to the specific, cash flow positive businesses that Blue Owl actually lends to.
Okay, we've laid out the bull case, a fortress of growth and stable earnings. The Skeptic has stress-tested the foundation, highlighting the market's fears and the very real cracks in sentiment. We've weighed the steel, now it is time for the iron verdict. After analyzing the evidence from both sides, it's time for Iron Financial to deliver its final, no-nonsense judgment. Is this massive stock decline an opportunity to buy a structurally sound company on sale, or is it a trap?
Here's how we forged our verdict. Step 1, we have to acknowledge the growth engine. You just cannot argue with raising $56 billion in a single year. The AUM growth and the quality of that permanent capital are undeniable pillars of strength. Step 2, we must respect the market's risks.
The redemption pressures are real, the stock's reaction to that failed merger was severe, and all that bearish options activity signals genuine concern from professional traders. You cannot just ignore those signals. But that leads us to step 3, identify the disconnect. The core profitability, that fee-related earnings engine, appears incredibly resilient and is growing at a double-digit rate, even as the market narrative focuses on all the risks. The fundamental structure seems to be holding up, and maybe even getting stronger, despite the storm that's raging outside.
So, our verdict is this. Blue Owl appears to be a structurally sound company that has been forged in the fires of market fear. The market is focusing on legitimate but potentially manageable headwinds in specific products and macro sentiment, while seemingly ignoring the powerful, growing, and highly profitable core engine of fee-related earnings. The insiders are buying because they see the strength of that core engine every single day. The market is selling because it sees the smoke from the headwinds. This creates a classic disconnect. Now, while risks absolutely exist, and this is not a recommendation to buy or sell anything, our structural analysis concludes that the company's foundation, powered by its permanent capital base and FRE, appears solid. The current stock price may reflect more fear than fundamental decay.
And that leaves us with the final, crucial question for you. The market feels a tremor and sees cracks forming on the surface, but the company's blueprints, its core financials, and its growth metrics show a solid foundation. The question you have to answer is this: do you trust the blueprints or do you trust the tremor? Answering that is the hard work of building a stronger portfolio. Do your own homework, dig into the numbers, and decide for yourself. Make sure you subscribe for more reports where we test the structural integrity of the market's biggest names. We'll see you next time on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.